My name is Steve Jenkins, and I have responsibility for the banking supervision function at the Federal Reserve Bank of Cleveland. And I have the honor of introducing our luncheon keynote speaker, Federal Reserve Governor Lael Brainard. Prior to becoming a member of the Board of Governors of the Federal Reserve in June of this year, Governor Brainard served as Undersecretary of the U.S. Treasury Department from 2010 through 2013 and was a counselor to the Secretary of the Treasury in 2009. In this role as Secretary, she served as a U.S. representative to the G20 finance deputies and to the G7 deputies and was a member of the Financial Stability Board. She received the Alexander Hamilton Award for her service during this time. Prior to joining the Treasury, Governor Brainard was Vice President and Founding Director of the Global Economy Development Program at the Brookings Institution. In this role, she built a new research program to address global economic challenges. Prior to the Brookings Institution, Governor Brainard also was an assistant and associate professor of applied economics at MIT's Sloan School of Management, and she has also been a consultant with McKinsey & Company. She has published numerous articles on a variety of economic topics and has been an editor and co-editor of several books. Dr. Brainard received her BA with University Honors from Wesleyan University and has a master's and doctorate degree from Harvard University, where she was awarded a National Science Foundation Fellowship. So please help me in welcoming Governor Lael Brainard.
Well, it's a pleasure to be here, and thank you for that very kind introduction, Steve, and thank you also to Loretta Mester and to Dick Berner for inviting me here today. The agenda of the conference is one that certainly is preoccupying us a great deal. I'd say financial stability is more important than ever in the work of the Federal Reserve Board. In the wake of the financial crisis, as you know, Congress and, in fact, the Federal Reserve itself became much more deliberate and explicit about the responsibility for safeguarding the stability of the financial system. And the Dodd-Frank Act in 2010 charged the Federal Reserve with very specific authorities for the purposes of safeguarding financial stability. Subsequent to that, the board created the Office of Financial Stability Policy and Research to strengthen our cross-disciplinary approach to the identification and analysis of potential risks to the financial system and the broader economy, and to support macroprudential supervision of the largest financial institutions, and following its creation, participation on the Financial Stability Oversight Council. Most recently, the board created the Committee on Financial Stability to oversee this work. While the Federal Reserve is seen as the agency that has perhaps the broadest sightlines across the economy and some important stability tools, as well as a critical first responder when a crisis hits, the Fed faces important limitations. We are predominantly a supervisor of banks and bank holding companies in a financial system where capital markets are dominant. Regulatory authority is fragmented, and no U.S. agency has access to complete data regarding activities across the financial system. Recognizing these limitations, the Federal Reserve will need to actively utilize the tools under its authority, which means placing a very strong emphasis on structural resilience, while strengthening less tested time-varying tools to lean against the buildup of risks. In some circumstances, the Federal Reserve will need to look to the unique capacity of monetary policy to act across the financial system, and it will need to cooperate closely with other regulatory agencies. Our work on financial stability is proceeding in 4 pillars, and is in varying stages of advancement, and I'll touch on each briefly. The first pillar is surveillance of the possible risks that could threaten financial stability. Each quarter, staff undertakes a systematic assessment of key financial vulnerabilities, including asset valuations, leverage, maturity transformation, and interconnectedness in the financial system, along with borrowing by households and businesses, which research and historical case studies suggest provide important warning signals. Over time, our surveillance will benefit as the Office of Financial Research makes progress in facilitating the exchange of previously siloed data sets among the independent regulators and as international impediments are overcome. The research that informs this work, which those of you who are in the room know perhaps more than any, is helping to identify financial patterns likely to be associated with rising risks of financial crisis, and it's growing rapidly. But as you also know, its predictive power is still limited. It's difficult ahead of time still to identify credit booms that are likely to lead to damaging severe crises, such as the subprime crisis, from those that do not, such as the high-tech boom. For that reason, we supplement the regular systematic surveillance of financial developments with 3 other valuable types of analyses. First, we used detailed bank examinations and loan reviews that are the regular work of our supervisors to assess emerging risky practices. These reviews, for instance, helped identify deteriorating underwriting standards in the leveraged loan market. Second, we undertake periodic analyses of the potential system-wide consequences of shocks that are viewed as being particularly salient, such as a sharp rise in the level of interest rates or the volatility of interest rates. Finally, when there is a close brush with a specific risk event, we closely study the behavior of markets and institutions for insights into possible structural vulnerabilities and assess policy actions. That takes me to the second pillar. The ultimate objective of that surveillance, of course, is to build resilience and to counter risks early enough to prevent damage to the real economy. There are 3 dimensions of our macroprudential policies. First, I would say we're quite far advanced and compare favorably to other institutions in implementing a framework of new through-the-cycle safeguards that substantially strengthens structural resilience across several dimensions. First of all, it's forward-looking in assessing risks. It's explicitly macroprudential in design so that institutions that are large and complex are given incentives to take into account not only risks to their own safety and soundness, but to the system more broadly, and it requires large, complex institutions to build very robust capital and liquidity buffers. The core of the framework is the requirement of a very substantial stack of common equity to absorb shocks and provide incentives against excessive risk-taking. The new framework builds belts and suspenders by requiring not only a simple non-risk adjusted ceiling on leverage, but also requiring the largest banking firms to meet 2 sets of risk-based capital standards, one derived from internal models and another based on standardized supervisory risk weights. Beyond that, the largest complex firms will face an additional common equity requirement that reflects the risk they pose to the system and an additional layer of loss absorbency on top of that to provide adequate support to operating subsidiaries in resolution. They're also required to maintain substantial buffers of high-quality liquid assets calibrated to their funding needs and to run risk. Regular stress tests of both capital and liquidity at our largest banking firms provide a key bulwark in the new architecture. By providing a forward-looking assessment that takes into account possible correlations among risks under stress conditions, these stress tests are powerful tools for building resilience. But they also have some limitations. For instance, while the severity of the stresses can be varied from year to year, it's difficult to introduce entirely new scenarios each year to target specific sectoral risks without also introducing excessive complexity. And while banks are required to build buffers that are calibrated for the riskiness of their assets and exposures, the proportion of capital required doesn't vary systematically to counter the cyclicality that arises through elevated asset valuations and other channels. Progress is less advanced in developing tools to counter the buildup of excesses. Here, I think we can learn from financial authorities in other countries, some of whom have more recent experience with a broader set of macroprudential tools. The Federal Reserve is working to implement a countercyclical capital buffer. The classic case for this kind of a tool is to lean against a dangerous acceleration of credit growth and take the burden off of monetary policy under the assumptions that the degree of tightening that would be needed to slow down the growth in credit would be inconsistent with underlying conditions in the real economy. The Federal Reserve and the U.S. banking agencies issued a final rule to implement the new Basel III countercyclical capital buffer in 2012. Starting in 2016 and phasing into 2019, the agencies could require the largest, most complex firms to build an additional amount of capital up to 2.5 percentage points of their risk-weighted assets. Right now, we're considering how best to implement that buffer, perhaps looking to indicators related to credit growth, leverage, and other signs of financial imbalances to provide guidance on when both to implement and subsequently to deactivate such a buffer. While the buffer will be useful in building additional resilience near the height of the cycle, it may not be as effective in leaning against credit growth, since as a credit boom progresses, there's greater potential for capital to be relatively cheap, asset valuations to be inflated, and risk weights to be incorrect. Moreover, the countercyclical capital buffer only applies to a subset of the U.S. banking system, and it's designed to act with a one-year lag. It also cannot be used efficiently to target specific asset classes that might be frothy. In that domain, the Federal Reserve is exploring tools that can be varied over the cycle to target specific sectors, while recognizing we have limited authorities relative to some foreign regulators in operating on the borrowing side and beyond the regulatory perimeter of the banking system. I think property booms are among, or perhaps the most common macroprudential challenges that have confronted financial authorities in advanced economies over the years. Some foreign regulators have the authority to promulgate countercyclical rules that target activity specifically in this sector. So if you look at the Swiss example, the authorities activated in early 2013 a countercyclical capital buffer that added 1 percentage point of required capital for direct and indirect mortgage-backed positions secured by Swiss residential property. And then they increased this amount to 2 percentage points in 2014. In the U.S., by contrast, there's a more limited set of authorities. As we've seen with leveraged lending, and most commonly, the banking regulators acting together can use the tools of supervisory guidance and intensive supervision to discourage banks from taking on additional risk on safety and soundness grounds. Moreover, the annual supervisory stress test could be tailored to increase the severity of losses in specific portfolios of loans or in the market shock. But of course, these fall short of direct restrictions on activities in particular sectors. While the supervisory actions that I referenced usually flow from microprudential safety and soundness concerns about individual institutions, Section 165 of the Dodd-Frank Act potentially provides the Federal Reserve authority to restrict the activity of banks with assets greater than $50 billion or designated institutions on an explicitly financial stability or macroprudential rationale. In addition, we have authority under the Securities and Exchange Act of 1934 to set initial and variation margin requirements for repurchase agreements and securities financing transactions across the financial system. As some of you may know, this authority was used through the mid-1970s with what was seen as quite limited success, and it hasn't been used since. There's some renewed interest in exploring whether imposing minimum margin requirements on additional forms of securities credit might prevent margins from compressing during booms, and likewise help mitigate destabilizing pro-cyclical margin increases at times of stress, reducing the associated fire sales in short-term wholesale funding markets. It's instructive also to examine how central banks in several advanced economies have dealt with recent housing booms, including through borrowing side restrictions. Financial authorities in the UK, Sweden, Switzerland, and New Zealand have all confronted rapidly rising residential housing prices in macroeconomic environments where there were compelling reasons not to use the policy rate as the first line of defense. They responded, in some cases, by imposing restrictions on borrowers through loan-to-value or debt-to-income limits, in some cases in combination with disincentives to lenders, and in many cases in an escalating pattern. Indeed, restrictions on borrowing are among the most common macroprudential tools, and according to some research, among the most effective. This isn't a problem that we face today. If anything, we continue to face the problem of restoring vitality to the single-family housing market. However, if in the future a mortgage credit-fueled housing boom were again to reemerge, the banking agencies could perhaps impose risk weights on mortgage loans with particular characteristics, either directly or through expectations for the stress tests. But this approach would require upwards of a year to adjust, would be narrow in its scope of application, and would prove ineffective if bank regulatory capital comfortably exceeds the required thresholds. In some cases that I referred to earlier, foreign central banks acted in concert with other financial authorities to address the buildup of risks. In the American context, of course, the Federal Reserve's work is embedded in a larger web of efforts by independent regulatory agencies through the Financial Stability Oversight Council as well as directly. It's vitally important, given the fragmentation of our regulatory structure and the importance of our capital markets, that the bank and market regulators actively share assessments of risks and develop joint macroprudential efforts to address risks that stretch across regulatory perimeters. Realistically, however, those efforts are going to need to navigate differences in their mandates, authorities, and governance structures. So going back to the preceding example, the Consumer Financial Protection Bureau has authority to adjust the definition of qualifying mortgages, which affects mortgage credit at all lenders, whether inside or outside the regulatory perimeter. But it's important to note that the CFPB operates primarily under a consumer protection mandate. While the ultimate consequences of a mortgage credit boom have in the past proven quite costly for families, the danger to consumers in the early stages of such a boom might be too unclear to warrant timely action. So finally, recognition of the limits to the macroprudential framework brings naturally a consideration of monetary policy, perhaps the most powerful tool, but also relatively blunt. Monetary policy is the only tool available to the Federal Reserve that has far-reaching impacts on private credit creation across the entire financial system, and one of the few tools that can be changed rapidly. For the most part, monetary policy should be seen as a complement rather than an alternative to the macroprudential toolkit for financial stability purposes. Nevertheless, there may be times when standard monetary policy and financial stability considerations conflict. In several recent instances, foreign economies have faced some tension between labor market slack and shortfalls in inflation relative to their target on the one hand, and financial stability concerns associated with rapidly rising real estate prices on the other. In the United Kingdom, policymakers put in place a range of macroprudential measures to limit the buildup of risks in the housing market, including on the borrowing side, and partly as a result, the housing market appears to be cooling somewhat. Nonetheless, UK policymakers acknowledge the potential for monetary policy adjustments in the pursuit of financial stability when the Bank of England included a knockout clause in its 2013 forward guidance for specific financial stability purposes. If in the future the United States were to face a similar dilemma, where financial imbalances are growing against a backdrop of a weak labor market and subpar inflation, the Federal Reserve might more readily have to consider adjusting monetary policy for financial stability purposes than some foreign peers, Because our regulatory perimeter is narrower, the capital markets are larger, and the macroprudential toolkit is less extensive. Even in these conditions, however, I think it's important to be circumspect about the role of monetary policy, recognizing that the necessary adjustments could have broader consequences. A tightening in monetary policy sufficient to limit strong credit growth could depress employment and potentially trigger a sharp correction in financial markets. While being realistic about the expectations we place on monetary policy for financial stability purposes for that reason, it's important to acknowledge the potential importance of monetary policy for addressing risks to financial stability in the economy and to actively expand our work on the appropriate role of financial stability in the monetary policy framework. So, as a quick summary, while I think the Federal Reserve has a clear responsibility for financial stability, it also has an incomplete set of authorities and a limited regulatory perimeter in a system where capital markets are large and regulatory authority is fragmented. For those reasons, the Federal Reserve will need to actively utilize the tools that it has under its authority, which means putting a heavy emphasis on structural resilience, while working to build some tools that can counter excesses during the cycle, and at times looking to monetary policy as a powerful tool that has a unique capacity to operate across the entire financial system.